Welcome back. We speak with many senior homeowners every day. Most of them express a strong desire to remain in their home, and they tell us that running out of money or outliving their assets is one of their greatest fears. They tell us that their daily living expenses are increasing at a much faster rate than their income, and that their financial resources are limited as a result. Some of the problems they experience include unmet health care needs, unmet property taxes, deferred home repairs, late mortgage payments, and unacceptable living conditions such as inadequate heat in the winter months. Solutions that are typically explored include selling the home for more cost-effective accommodations or moving in with family members, increasing income by obtaining additional employment, seeking financial assistance from family members, and obtaining additional funds by borrowing against the equity in the home. Where borrowing against the equity in the home makes sense, traditional mortgages are usually not the best alternative for senior homeowners. Home equity conversion mortgages are better suited to meet the financial needs of senior homeowners than traditional mortgages for several reasons. First, home equity conversion mortgages provide funds on very favorable terms. For example, a 75-year-old homeowner may be able to borrow up to 68% of the value of her home at interest rates that are very competitive with traditional mortgages. Funds can be used for any purpose after the repayment of any existing mortgages. Because no monthly payment is required, the homeowner is able to allocate funds in a way that best preserves quality of life rather than requiring the funds be returned to the lender in a monthly payment. With a traditional mortgage, even when funds are scarce, a payment still has to be made or a serious event of default will occur that ultimately could result in the loss of the home to foreclosure. With a home equity conversion mortgage, you decide how much, if anything, is repaid every month. For example, if funds are limited in 1 month due to an unexpected home repair or to attend to seasonal needs such as heat in the winter, you can elect to use the funds that you would otherwise be used to make a monthly mortgage payment to attend to the need. Mortgage payments could be resumed as soon as funds were available. The term of the home equity conversion mortgage is open-ended, lasting as long as any borrower resides in the home as their primary residence. With traditional home equity lines of credit, the lender can terminate funds availability at their discretion, leaving you without the funds that you counted on to meet your needs. The home equity conversion mortgage, on the other hand, provides financial security and flexibility as long as you need it. So, with a home equity conversion mortgage, you have long-term peace of mind. Also, it's easier to qualify for a home equity conversion mortgage than a traditional mortgage. Qualification does not depend on your ability to repay the loan. It doesn't depend on your income, assets, or credit score. Qualification is based on the age of the youngest borrower on title, the value of the home, and prevailing interest rates. In order to be eligible, you must be a minimum age of 62. In addition, the property must be a 1 to 4 family residence or a HUD-approved condominium or a planned unit development. Your only obligations are to remain in the home as your primary residence, keep the property taxes, association dues if any, and homeowners insurance policy current, and keep the home in good repair. Also, no other liens can be placed against the home once the home equity conversion mortgage is obtained. A home equity conversion mortgage is a non-recourse loan, meaning that the lender can only look to the value of the asset for repayment. Where the value of the home is less than the outstanding mortgage balance at the time the mortgage is repaid, the lender cannot look to the borrower's heirs or other assets of the estate for repayment. So, your heirs will never be responsible for paying back the home equity conversion mortgage. And finally, the funds that are provided by a home equity conversion mortgage typically do not trigger a taxable event, although it's important that you consult with a tax advisor to verify your individual circumstances. And Medicare and Social Security benefits are likewise not affected by a home equity conversion mortgage. Again, it's important to consult with a government benefits advisor to verify your individual circumstances. Medicaid benefits, however, may be affected by a home equity conversion mortgage, and it's especially important for Medicaid recipients to consult with the appropriate advisor before applying. In the next presentation, we'll talk about the types of home equity conversion mortgages available, typical closing costs, and the application process.